Uh, Great. All right. So we're recording now. I'm going to go ahead and share my slide deck here in the next couple minutes, and then we'll send it out to the group as well. I think we're a small enough group that if you have a question as I'm going, either unmute yourself and just ask the question, or of course, go ahead and enter the question into the chat box. Kind of my intentions for this slide deck, it's not like the full catastrophe that you usually get from me where I talk for like 2.5 hours without stopping. It's kind of meant to be kind of touching on some of the things that I'm thinking about after 2020 and going into 2021. And so I wanted to share with you some of the things that I'm thinking about. Certainly I'm hoping that maybe some of those things lead to lots of question and answer. So I feel like, you know, with a group, there's 15 of us here. You know, it's like the perfect size group to, you know, to have some back and forth about different issues. And certainly, like, I think that I'll probably wrap up with my slides with enough time to ask any other questions that maybe aren't covered in the slide deck. And so we can, you know, we'll just plan on being here until 4:30 and we'll just see how it goes. All right. I also, you know, I wanted this to be like really useful information. So it's, so some of it gets a little bit like inside baseball, right? But I'm hoping enough of it is kind of a intro level to lay the groundwork for people who are maybe just coming into the group at the very beginning. So I'm trying to cover everything. You guys know how I do it. So, so without further ado, I'll just start with my slides. Oh, let me share my screen first. Okay, can I get this to work? Yes. All right, so again, like I'm starting to think through what I think are the fundamentals of investing in 2021, right? What are we to be thinking about as we go forward? Certainly some of them will have something to do with what 2020 has been like, also like what can we expect for the next year? Because as Lori mentioned, right, one of the things we're always talking about here is how investing is forward looking. So that can really be that really what is happening right this very second from the stock market's perspective and a lot of kind of the fundamentals of investing. What's happening right this very second is not as important as what you expect to happen in the future. So there's always keeping this focus on what might happen. The stock market is not the same as the economy. The economy, to me, is, you know, what is happening right now. The stock market is usually anticipating what might happen in the future, right? So they're related, but they're not the same thing. And that trips people up quite a bit. Here's a couple of disclosure slides, right? Those will be on the slide deck when I send them out. Nothing is intended to be individualized investing advice. Past performance is not indicative of future results. We're doing the best we can with the information from the past in order to make some of these forecasts and projections in the future. But really, I mean, what makes investing so scary and fun and profitable for some people and unprofitable for other people is we are trying to make forecasts about an unknown future, right? Nobody knows the future, but we're trying to do our best to make our best guess. Where can we put our money in order to potentially make more money in the future? You guys already know about me, so that's fine. I'll go through that. Okay, so these are the three themes that I think will be major in 2021. So the first one is don't fight the Fed. This plays out in several different ways for all types of investors. First of all, I'm going to skip to the bottom bullet point there. It says low rates are good for borrowers, right? The Federal Reserve has lowered short-term interest rates all the way back down to zero, right? They're doing this to support the economy and to keep money flowing through the economy. And what this means from an investor's perspective is it's pretty cheap to borrow money. Because of 2020 being what it is, it's not easy money for everybody, right? Like you probably need to have a job or some source of income. You need like a good credit score. You need to be able to show the bank that you're going to pay them back. But if you have those three things in some capacity, you're probably going to be able to borrow at a really low rate. So for just like kind of normal people doing their thing, like one of the effects of this is you can get a low mortgage rate, right? Are you a home buyer? Are you a homeowner? Do you want to buy a home? Rates are really low. Can you refinance your mortgage? Rates are really low. And they're probably going to be that way for a while. It even like trickles through to, you know, low rates on car loans. Maybe you have an opportunity to refinance student loans, things like that. But the cost of borrowing money is pretty low and expected to stay low for a long time. On the flip side, that means that low rates are not good for savers, right? So for those of you who got pretty comfortable with those 2% rates on your high yield savings account, just kiss them goodbye. They're gone, right? Like they're just gone. We are in a low interest rate environment. So depending on what side of the spectrum you are, the rates are low, right? So this flows through because what low rates tend to do is support the price of assets. So if we go back to the housing market, an easy way to think about this is low interest rates make it easier for people to borrow more money, which tends to inflate the price of houses, right? Like all things being equal, if someone can get a mortgage at a 3% rate, they'll be able to borrow more money than they could at a 4% rate. And so now they'll have more money to spend and you can bid up the price on houses. You know, in Austin, this is just like, some of this is being driven by demographics in Austin, but some of it is being driven by low rates. So that idea applies not just to housing as an asset or houses or real estate as an asset, but I think in 2021, it's going to apply to asset prices in general. One of the cutesy ways that we kind of talk about this dynamic in the investing world is with the acronym TINA, T-I-N-A, which stands for there is no alternative. And what that means is like, if you have money to invest or you have money to save, that 0% high yield savings account is going to get really painful the longer that rates stay at 0%. And even very conservative investors are going to start taking their money out of cash and taking a little bit more risk in order to get a higher rate of return. So maybe someone who otherwise would have been in cash, they move to bonds. And people who are in bonds and not super excited about the 2 to 3% interest rate in bonds, maybe they move a little bit into stocks. But what this does is it might provide like it's not exactly a floor, but it's a support for assets. If I'm thinking through 2021, I think that this idea of don't fight the Fed, what I would take from that is I wouldn't expect a crash like we just saw. I wouldn't expect a crash like we saw in March. So if you are waiting for the second dip in the stock market in order to buy, I don't think that it's going to come. That doesn't mean the stock market won't fall from here, right, at or near all-time highs. I just don't know if there's so much money in the system looking for higher rates of return that I think in 2021, it looks like the market falls maybe by 5%, maybe by 10%. But I don't know if it gets all the way to 20 or 25 or 30 again, which for some people is like, awesome. I don't really want the stock market to fall 30%, right? But for other people who are waiting to maybe have cash and are waiting for a dip, I don't know if you can wait for a 20% dip or a 25% dip. I would say if you're waiting, maybe it's a 10%, maybe it's a 5%. Again, this is just how I'm thinking about the world and just kind of want to throw that out there. Chairman Powell, right, from our Jeopardy question, that was awesome that tied back in. Jerome Powell has said that the Federal Reserve is not even thinking about raising rates. So I think this is going to be a dynamic that's in play through 2021, maybe even through 2022. So don't wait for those 2% high yield savings account rates to come back. If you have debt to refinance it, but expect that this low interest rate environment supports asset prices. to some extent.
Hey, Sarah, quick question.
Yeah.
So not leaving it in cash is a good idea and potentially getting into the market, but you still think the market might dip. I guess the question on my mind is, when do you know when to get in? I mean, I know nobody absolutely knows or we'd all be filthy rich, but it's just, as somebody who's a little more conservative, it's hard to just jump in whenever hearing both sides of that, not knowing what to do.
Yeah. Yeah. I mean, that's an excellent question. This is how I think about it, right? Like, if I have a certain amount of money that I am trying to grow over time, can't sit in cash, right? Because that's not going to do it. Like, we know that cash is not going to grow. So what, like, from a systems perspective, how do you make the decision to get back in? I think that it's much easier to chop it up into a series of decisions that you make over time, right? So it's like dollar cost averaging. So if you have $50,000 that is earmarked for the long run, it's part of a retirement plan, it's part of, it has 10, 15, 20-year investment horizon for that money, I would do something like take the 50,000, divide it into 10 $5,000 chunks, and then invest it every 2 weeks until it's invested. And that maybe layering on top of that. So that first point, like, puts a time bound on your decision making. That, like, okay, you are investing this money in the next 20 weeks. And then it's going to be invested, and we're going to take what comes. So that's one way to kind of develop that discipline and maybe take some of that timing pressure off of yourself. If you want to be even a little bit like more nuanced than that, I think you continue along that same general idea. I'm going to invest $5,000 every 2 weeks for the next 20 weeks. But if the market falls by 5%, 10%, 15%, whatever it is, if the market falls, I accelerate the amount that I put in. So maybe instead of $5,000, I put in 7. Or if it really falls, instead of $5,000, I put in 10. So that'll kind of, I think that it helps change the psychology of the decision making, because it turns a market crash, instead of it being something to avoid, it becomes something that you hope will happen, because you're trying to invest your money, right? So you want to try to get it in when the market falls.
No, that's very helpful. Thank you.
Yeah. I mean, as far as like what the right level is, I mean, one other thing that, I mean, just because I'm just like full disclosure, just kind of like stream of consciousness, giving you information. In my head, a fair price for the S&P 500 is probably something between 3,200 and 3,600 on the S&P. Anything above that, I'm not super excited. Anything below 3,200, I mean, at this point would be like a crash scenario, and it would be like, get everything in if the market fell below 3,200, which I don't think it will. But if the price of the S&P 500 is somewhere between 32 and 36, I think that that's a level that over a 10-year time horizon, you're going to make money. Over a 1-year time horizon, maybe not. But like that, I think 3,600 on the S&P is fine. It's fair, right? If we go back to Buffettisms, like, what's that Buffettism? It's better to buy wonderful companies at a fair price instead of fair companies at a wonderful price. It's kind of like that idea, like, okay, like, is it fair enough to put money in the stock market at 3,600 on the S&P? Like, yeah, I think that's fine, as long as you have a long enough time horizon. If you're really a bargain hunter, then anything below 3,600, I wouldn't wait too long. I wouldn't pass up very many opportunities between 3,200 and 3,600 to get money invested. So hopefully that kind of made sense.
Yes, thank you.
This is not individualized investing advice. I already said that on the recording, right? Okay. Continuing along that path, I mean, I don't know, like, some of you were at our last in-person Austin Women's Investing Group meeting, which was in February of 2020. right? Where we were talking about coronavirus and wondering whether it was going to impact the stock market and the economy, right? So we're through 2020. I mean, we know so much more now. COVID vaccines are coming, right? We are closer to the vaccines now than we were back then. Congress has exhibited some appetite to step in with some amount of stimulus, right? That means that in addition to the Federal Reserve using their banking tools to help support the economy, Congress has, again, they fight about it, right? But to some extent, exhibited, the wherewithal to step in and send people money who need money. These are lessons that were learned from the financial crisis in 2008, 2009. And so there have been economists, market experts studying what could we have done back then that would have saved the people living in America, that would have saved people the amount of pain that they ended up going through during the financial crisis. And the answer seems to be, like, at least the economists that I listen to, the answer is you send people money, right? You send people money in order to keep them from falling into poverty. And that is, something that certainly in a case like COVID should be something that the government should be willing to step in and do. Like, we can send people and businesses money in order to keep people and businesses and families from failing. So what that means is that hopefully you don't have a bunch of people, businesses, regional economies, national economies going into a downward spiral, right? So if you have vaccines on the way and you have stimulus on the table, I think that is supportive, right? Because it means that you don't have a bunch of people who need to sell all their stocks or sell their house or, do kind of those last ditch efforts to, like, live to fight another day. That you have someone, in this case the federal government, coming in and saying, okay, we're gonna try to keep you from that point where you have to make those really painful decisions to just start having garage sales, fire sales everywhere. They want to stop those things. And to kind of keep going with that idea, the GDP, the gross domestic product in the US, is basically 70% consumer driven. So the health of the consumer is really important to our economy. You can contrast that with, like, China, where something like, I don't know what it is right this very second, but like 30 to 40% of their economy is driven by consumers in China. The rest of it is exports, right? We're flipped here. So the health of our national economy is driven by people's ability to spend money, right? You take your paycheck and you go somewhere and you spend it, and that spending turns into someone else's paycheck, right? So it creates this positive feedback cycle that we're trying to get that going again. So that is also supportive of asset prices. If people don't have to sell stuff to pay the bills or put food on the table, that's good, right? Or if they, get back to work and have more money and can start contributing to 401ks or buying a new house or whatever it is, that means there are buyers in the market for these assets, and you would expect prices to at least be stable. And I'm not saying that this means prices shoot way up from here, but I think it at least means it'll hopefully be more stable going forward than it was in 2020. In March, the market fell really, really fast because all of these things that I'm talking about now, people's perception of them, it was in the reverse, right? It was like, oh my gosh, everybody's going to lose their jobs. Nobody was really talking about stimulus quite yet. They stepped in pretty quickly, but there was like, okay, where are people going to get money? If they can't work, what's going to happen? Is everybody going to lose their job? Everybody's going to lose their house, right? And looking forward into the future, when those things were possible, people's first inclination was, I have to sell everything and get safe. I have to be safe, right? I don't think there's quite that panic mode going into 2021 as there was during March of 2020. So again, I just think this means that if you have been waiting for things to get better to get back in the market because you're more conservative, things are better, right? And I know it's crazy to say that in the middle of a pandemic, right? That where, we keep seeing, I know the COVID numbers, right? So like, I don't have to reiterate that. I know you all do too, right? So, but we're like, investors are kind of assuming that we come out of that at some point. And the going through the process of getting through the next few months from a human perspective is going to be terrible, right? And there's a cost to running the country the way we're running it. But from a financial perspective, it seems like there is the wherewithal to keep people from falling off a financial cliff. So that's my second bullet point. Are there any questions on that one? Then if we go down to the third one, I put secular trends are still in play.
Sorry, Sarah, I couldn't find my mute button or my unmute button. So I feel like I just saw in the New York Times the jobless numbers, and like there was this steep, ridiculous cliff, and then it went up, and then they've gone down again. So how does that, in terms of this whole, or maybe it was unemployment claims, or that so many people have left the workforce, i.e. women, that I'm just curious that we hear so much about how many women just are, because of home, kids are home now, how long it will take for that sector of the economy to recover. And it's hard to believe there won't be economic consequences to single income households that used to be double.
Yeah, and that's an excellent question. And obviously, like everything I say in all of these, like nobody really knows, right?
Yeah, of course. Yeah.
Right, because the system is so complex, right? Which you just pointed out. So I would say that it seems like the way people are thinking about this is if you have people either permanently out of work or out of work for longer than you expected, that will probably be a drag on growth, right? Like you took productive people out of the economy and just made them not productive, right? And that's not great from an economic perspective. So, if I go back to the themes for 2021, maybe it means like, okay, maybe the investing landscape for 2021 isn't awesome, right? But maybe it's not terrible, right? Where you have these competing themes. And that's really what the economy always is, right? If you have like these competing themes, you have people who are still unemployed or underemployed. And that's dragging down economic growth. But I mean, if we kind of pivot to the stock market, when companies lay people off, people and payroll are a really big component of the cost of running a company. So if money coming into the company is kind of the same, maybe a little bit lower, but their costs of doing business are way lower because they laid people off, their profits are actually higher. And that's good for stock prices, right? And so I think those competing trends and themes, like they kind of fight with each other, right? I mean, and that's part of why the markets go up and down. But I think that's how a weaker economy doesn't necessarily mean a weaker stock market, right? Again, like going back to like the economy and the stock market are not the same.
Yeah.
Right? Stock is ownership in companies. And as the owners of companies, we want the company to be as efficient as possible, which in the world that we live in sometimes means people get laid off, right? And maybe they get added back slowly. As the economy improves, companies have to start hiring people and profits might actually go down as the economy grows. So I think from an economic perspective, like I read those articles, right, where it's like women are set back by 20 years. Yeah. 9 months, we're set back 20 years. And it's awful, right? And there are certainly policies that could be put in place to help mitigate that. But from the stock market's perspective, I don't know if it's as much of a detriment as one would assume.
Okay.
Right? That like if people get like, and you can see this in the news with stocks. Like 3M is going to lay off 3,000 people, and you would think like, oh, damn, that's bad news, right? But the price of the stock goes up because you're like, oh, all right, 3,000 people times $60,000 per year, you know, however many years actually means more money might come down to the bottom line. This all does kind of flow back to like my hope that more women control more wealth and more ownership in companies, right? Because owning assets can mitigate some of the risk of, like, for example, like losing your job, right? But you still have wealth accumulated even if you temporarily or permanently lose your job. And I know that like it's all a work in progress, right? And that's not the answer, but I do think like as we go through our careers, it could be one of the answers. Did that answer your question at all?
Yeah, I mean, I think just the reminder, the weird disconnect between the economy and what the stock market is interested in and how well it does with efficiency versus like ravaging people's personal lives is an uncomfortable truth, but it's a good reminder that that's how it works.
It's an uncomfortable truth. That's a good way to put it. The cheapest thing would be to replace all the people with robots eventually, right?
Yeah.
So it's like there are a lot of stocks that would like that, right?
Yeah.
So it is like that disconnect between the stock market and the economy is, I think, what has tripped investors up the most in 2020. Because by the time you're waiting for the economy to get better, the stock market has already reacted. And we saw that on March 24th, right? The Federal Reserve came in on March 23rd. They started talking about stimulus, and it looked like stimulus was going to get passed at the end of March with the CARES Act. And the stock market took off. And you had a bunch of people who were waiting for the news to get better before they felt comfortable investing again. But by the time the news got better, it was too late. Well, not too late. It's never actually too late, right? But the stock market has already, improved by something like 50% since the end of March.
Yeah.
So the economy and the stock market are not the same. Really good question. That's also why, like, as investors, we go back to the long term and not trying to make choices in the short term. Like what we saw in March 2020, and with people like really getting more interested and feeling like they had to make all of these short-term predictions, which were very difficult to make. 2020, like we saw the whipsaw. That's what we call it in the stock market, the whipsaw. When the market goes up and down so fast that you find yourself, if you're making short-term predictions, you find yourself on the wrong side of every move. The market's going down, so I'm going to sell. It's going up, so I'm going to buy, right? You're going in the opposite direction. If in the stock market you get out of the 1-year time horizon and you extend out to 5 years or 10 years, you will be a more successful investor. Because then when something like March 2020 happens, instead of asking yourself, what's going to happen in April? You say, well, what's going to happen in 5 years from now? And when I would ask people that question, like, what do you think the world's going to look like in 5 years? People are like, I mean, probably better than it is right now, right? In March of 2020. Okay, so can we get to 5 years out? That's a much easier investing time horizon to make decisions on versus like, what's going to happen? At the beginning of next year, next quarter, next year, whatever it is, right? Like zoom way out and think like, okay, what's the world going to be like 5 years from now and 10 years from now? And that goes back into like that goes into the third bullet point, which secular trends are still in play. So the things and the trends that were gaining momentum before COVID, most of them accelerated out of COVID. So, for example, like genetics and custom medicine and some of the technology in the healthcare space, right? Like that was a thing that people were working towards, right? Like, wouldn't it be cool to have custom medicine? We could analyze your genome, and then when you get cancer, we give you the medicine that's specific to the genome of that cancer that you have in your body, instead of kind of the scattershot approach that we have now. Out of COVID, all of a sudden that technology became super important, right? Like they analyzed the genome of the virus right away at the beginning as soon as it was identified. And people used that information to create the vaccines faster than they'd ever been developed before in history, right? So that is technology that we can use going forward to improve people's health outcomes going forward. It was a trend, and then it accelerated coming out of COVID. Working from home is another one. Like that's like the classic example of 2020, right? Like before that, people were talking about like, wouldn't it be great if more people could work at home? And then in March, everybody worked from home. And now companies are like, oh, well, we're going to keep some of this and do this going forward. We're not going to go back to the way things were. So if you can kind of think about some of those trends, it might give you confidence in certain parts of the stock market. What are the companies that are solving the problems of tomorrow? Like those are the companies to invest in. How are people voting with their dollars? And what are the companies who are creating the goods and services to appeal to those people, right? So there's, autonomous vehicles is another one. Electric vehicles in general is one. So there's, you can kind of just think in your own life, like, okay, like e-commerce, I don't know, does anyone use Amazon, right? Like that was a thing before March, and now it's like 10 times what it was before March, right? So you can kind of be thinking of those spaces as places that you might want to invest. The speed of innovation seems to be accelerating, right? So these changes, I think they seem to be happening really fast. You don't have to get in on these ideas on the ground floor, right? I think that owning a company like Amazon, even like whatever its stock price is today, 3,200 or whatever it is, right? Probably still pretty decent company to own, right? Something like Microsoft, right? Like all of these, big, huge companies that are already big and huge, they're also the leaders in, in the economy of tomorrow. So don't let like price or things like that necessarily keep you from those spaces. On that note of things being faster, another trend that I suspect is that in the stock market, the declines and the recoveries, I think, are going to be faster because of algorithmic trading. And this is something that you wouldn't know if you maybe weren't in the space, but think Flash Boys, right? That Michael Lewis book. I don't know if they ever made a movie about that. But there's so much of trading and investing is now driven by computers and algorithms that I think we're going to see sharper, shorter movements in the stock market. In March, which was, in March we had the stock market fell by 34% in something like 3 weeks, right? And then recovered. It took a little bit more than 3 weeks to recover, but it recovered pretty fast. And even going back to 2018, I don't know if you guys remember this, the inverted yield curve at the end of 2018 and the stock market flipped out. Seems so long ago, right? Stock market fell going into Christmas, right? It fell something like 20% in 3 months. And then it recovered. People were waiting for it to dip again so they could get in because they missed it the first time, and it didn't. So now, the last 2 times the stock market has had like a legitimate bear market 20% plus decline, it kind of looks like a V or like a very strong check mark. It doesn't look like, it doesn't retest its lows is what we say. Like people keep expecting it to go down, come up, then go down again before it starts going back up. And 2 times in a row that hasn't happened. I know 2 times in a row is not exactly a trend, but but I do think that the rise of algorithmic trading and also like the Robinhood traders, right? Like the market is just, it's changing. It's a little bit different, right? So, this I think goes back to my opinion that if you're in the stock market, you need to be in it for the long run, right? Because if you can't trade those events very easily. It's really easy to end up on the wrong side. Any questions on that last one? Kind of the idea that secular trends are still in play? All right, then I'm going to keep going. Just really quickly, I know maybe we're past the time when this is relevant to people, but I just wanted to bring it up anyway because I got a lot of questions on it going into November. Stock market and politics. Stock market doesn't care who's in office. I know that is so hard to believe. I get it that it's so hard to believe. But the stock market just doesn't really tend to have a super strong reaction one way or the other, depending on who's in office. So I got a lot of questions about that. But so this is kind of a cool chart going back and, you know, showing all of the different administrations, you know, red for Republican, blue for Democratic. And if you just kind of eyeball it, like you can obviously see, you know, periods of time where it looks like the stock market is doing better under one administration versus another one. But I mean, it's really kind of hard to see like a real pattern. And if you go back and look at the rate of return that occurred over each administration, I think I've seen studies showing that the stock market performs slightly better under Democratic administrations, but it's not really enough to make, don't make it your investing thesis. And here again, this is the economy, right? So gross domestic product, GDP. Again, it's really hard to look at this and see how, you know, GDP most of the time is just kind of like a steady, like slow moving, like a cruise liner, right? It kind of might start going a little bit faster, it might fall a little bit, but it's kind of just trending all up all the time. So here, like going back, if we just look at like the Obama administration into the Trump administration, it's pretty hard to make the claim that there was a serious change in GDP growth between those two administrations, right? So I don't think you can make the claim that the economy is better under one party versus the other party, even though people love to. But it's not as simple as that, right? Like the world just isn't as simple as that. So it always, every election year, I have to bust out a chart like this just to be like, we don't make investing decisions based on who's in office, or at least broad ones. Any questions on that? Good, let's just get out of elections season, just out of that whole thing. How am I doing on time? I don't have my phone for some reason. Hey Gwen, can you tell me what time it is?
We're almost at 4 o'clock.
Okay.
Yeah, 3:52.
Okay, well, thank you. If we zoom back, just kind of wanted to come through some of the basics of investing too after talking about some specific things. Remember the two main ways that investments make money. Some people get fixated on one or the other, but kind of forget that most of the times these two things go together. So your total return is your change in price, so the amount that the price of the asset goes up or goes down, plus any income that you receive. Back from Jeopardy, Gwen already told us that the price of an asset is something that you own that you expect to increase in value. The price of an asset is simply where a buyer and a seller agree to make a transaction. So if you've ever listed your house for sale, you have a list price and then you have a purchase price, right? The list price is like what you're hoping for, or you know, what you're listing it for, but the actual price of your house is where you have a signed contract. That's where a buyer and a seller have agreed to make a transaction. And asset prices are changing because investors' expectations about the future are always changing. So, okay, I'm looking at this house. Do I think it's worth $400,000 or do I think it's worth $425,000? Right? Like that probably has something to do about what my expectations about the future are. So that's the price changing part of it. And that's the part that we really see in the stock market, right? Like S&P 500 is up 50 points, it's down 200 points. It's, you know, like that's the price change of the asset of stocks. But many assets also generate income, right? So stocks, many stocks, not all of them, but many stocks pay a dividend, which is a cash payment to owners of that stock. So like Microsoft and Apple pay a dividend. Tesla and Facebook do not. If you're investing in bonds or loans or lending someone money, then you receive interest for doing that. So that's a cash payment to you. If you own real estate and rent it out, you receive rents, right? So that's the income piece of your investment. Depending on what type of investor you are, maybe income is more important, or maybe the price growth, hopefully, the price change is more important. Here's just like, I'd like to show this chart just to get people's expectations right about risk versus expected return for different asset classes. So the different types of things that you're investing in over time. So I think this is a pretty cool chart. It's from 1994 through last month, I believe, of 2020. And so what it's showing is on the y-axis, which I think is the up and down axis, we have compound annual return. So this is your expected rate of return over time. This number is the actual rate of return each year, an annualized rate of return. Then on the x-axis going across, we have something called standard deviation of annual returns. This is a measure of risk. It's a measure of volatility. How much does the price bounce around from year to year? If you expect to get 5%, but you actually get negative 5%, that would be reflected over time in standard deviation of your annual returns. So what it's actually showing is like your risk on the x-axis and your expected return on the y-axis. So here in the bottom left-hand corner, we have cash and bonds. Over that period of time, 1994 to 2000, relatively low risk and relatively low-ish returns over that 26-year time horizon. And then if we go out here on the risk spectrum, we're going over to the right to where things are really getting volatile. This is where we have our high risk, high return asset classes. So up here we have large US stocks. So this is the S&P 500. We have commercial real estate is this diamond, not your house, it's commercial real estate. And then we have small US stocks. And we can see like, okay, we took more risk. The price change of those assets was much more severe from year to year, but over the 26-year time horizon, we were compensated for taking that risk with a higher rate of return. So here between, I don't know, 8.5 to north of 10% in stocks. While if you were kind of playing it safe over here in cash and bonds, you would have gotten a lower rate of return because you didn't take as much risk. So we would expect this relationship to hold going forward. It means that if you want a higher rate of return, which the way that I like to think about it is at higher rates of return, your money doubles faster. How fast do you need your money to double? It would be awesome if it was every year, but that's not realistic, right? But in the stock market, just the math of this means that if we're in the S&P 500, we expect, but there's no guarantee, we expect the stock market to double every 7 to 10 years. So how much money do you have to invest and how fast do you want it to double? You can also Google the rule of 72. That's a good way to kind of conceptualize that too. If you can wait 30 years for your money to double, then maybe you can be in cash or CDs or bonds. But most of us need our money to double faster so that we end up with enough money to retire. Any questions on this one? I went through that kind of fast. We'll spend more money on this chart in January and February because I'll probably do like an intro to the stock market and investing for beginners type of thing in those months next year. So coming up, kind of skip over this part of the stock market because I think I already mentioned most of this stuff. Stock is ownership in a company, so that's really important to remember and understand. Here with the income statement, going back to, I think what I kind of already discussed this based on Caitlin's questions, like this idea that the stock market is disconnected from the economy, Like this is like a highly stylized income statement where we see revenue at the top line, right? So this is the money that a company brings in. Then they pay their cost of goods sold. Then they pay their operating expenses, including something like payroll. Then they pay interest on any debt that they've borrowed and taxes on any money that's left over. And after all of those people get paid, you have something called earnings, also known as profits. Earnings are what drive stock prices. If you're the owner of a company, everything else gets paid first before you have a claim on what's left over. And here, I love this chart, so I kind of show it all the time. This shows that relationship between earnings, which on this chart, the red line are S&P 500 earnings since 1988, and the price of the S&P 500, which is the black line. So you can see that most of the time, this relationship, it's pretty solid, right? Like if the red line goes up, the black line goes up. If the red line goes down, the black line goes down. There's a major bubble back here during the dot-com era, kind of year 2000, right? Where the price of stocks got way higher than the profits those stocks were able to generate. Bubbles always end in tears, right? So there was a market crash and people lost a bunch of money. Then earnings started growing again here in the early 2000s. Then we had a bubble in a different asset class. We had a bubble in real estate. So when the real estate bubble burst, it dragged down the profits of especially banks and the financial sector. So earnings fell and the stock prices fell down with it. Since then, we've had a pretty good relationship here between earnings growing over time with a cycle, right? So kind of up and down, but mostly up. And then we get to where we are now, right? The red boxes are the estimates for earnings for 2022, or for 2020, 2021, and 2022. So what people think S&P 500 profits will be in the future. They're just guessing, right? They're just estimating, I guess is a nicer way to put it. And then the price of the stock market is trying to anticipate that. So if you look at this chart, like it looks like, oh, dang, man, that black line is way higher than the profit estimates, certainly for 2020. But no one cares about 2020 anymore because it's already basically in the past. But even like looking forward to 2021 and 2022, it looks like the stock market is already anticipating the profits in 2022, right? So it's totally jumping over 2020. It even looks like it's jumping over 2021, and it's already looking forward to when times are good again in 2022. But again, this shows, like this is the chart that shows the stock market is anticipatory. It moves before something happens. So thinking about 2021, like again, like I think that if you can imagine that black line kind of going sideways, maybe kind of up and down, but sideways, as it kind of reaches over towards that 2022 expected earnings number, that's probably a good base case scenario for what would happen in 2021. So not necessarily a crash, not necessarily going up anymore, but it might go sideways for a while. Like don't be surprised if something like that happens. Whether or not it certainly could go up higher from here. If we go back to Tina, there is no alternative. How long are people going to hang out in 0% cash before they start taking more risk? That could drive prices higher. I mean, just good news and FOMO, all of those things could drive prices higher. But I do think my assumption for 2021 is that the market will kind of go higher and lower, but mostly sideways for some period of time. Again, that's just like a super guess. Like if someone had to make me guess what was happening in the next year, that's what I would guess. But I think if you look out on this chart and you try to look forward to 5 years out and 10 years out, you can eyeball what the trend is here as far as profits and the price of the stock market. Like they trend up over long periods of time. There are plenty of shorter periods of time where things are a total disaster. But over the long run, it's much easier to project that, okay, like the black line will get up into the S in earnings, right? Or kind of start going off the chart as we go along in time. We don't know when exactly it's going to happen, but I mean, I think there's a pretty good chance that it does. Any questions on this?
Yeah, I haven't. Oh, I just unmuted. If someone else does, I'm happy to wait.
I can't see anybody, so I'm just gonna.
Oh, okay. This is Caitlin speaking. If someone wants to interrupt me, please do so, or chat, say I had a question first. So I just need to keep reminding myself, because when I walk around my little downtown here, I see a shut movie theater. I see a shut concert venue. I see shut, like all these brick and mortar businesses shut. And I have no idea if any of them represent companies that are on the S&P 500. You know, I assume large events are, and that a lot of them will recover, and that other industries will reinvent themselves, or, you know, movie theaters will clear out all the rats and somehow we'll be able to sit in there, reupholster everything. And I just have to keep reminding myself that all of the companies are folded into this. So new companies that are making masks, amazing. Zoom is in there along with the ones that might not survive this. And I think I asked you this before, but like when that 500 companies gets reevaluated,
Yeah.
I would think this is a time where some will just clear out. We have no idea if they're coming back, and others will be zooming to the top. I'll take my question off air.
Yes, that is, I mean, that's an awesome point, right? I'm talking about the S&P 500. So this is a basket of large, well-known US companies. So the largest companies in the S&P 500 are Apple and Microsoft and Facebook and Google. And those companies are in there. Interestingly, a huge company that's not in there yet is Tesla. And so like the news in the S&P 500 world, if you're a nerd and have been kind of paying attention to this, they're adding Tesla to the S&P 500 this year. And they're trying to figure out how to add such a huge company to this basket without like making it crazy. But we don't know which company Tesla's replacing yet. They haven't told us that yet. So in that basket, there are definitely, like even in normal times, there are winners and losers, right? There are companies that are on the ascent. There are companies that are on the descent. Those companies that are on the descent, they eventually kind of get kicked out. Maybe, I mean, think maybe like 3 to 5 per year. Just like, they just like get ushered out the door and someone replaces them. So there is some turnover in that basket. But you're right, like all the baskets are together, or like the basket is all together. So in there are companies in the hospitality industry, which is just the worst, right? Like we all know this, like terrible. But also in that basket are these work from home plays or these gigantic money-making machines. They're in that basket too. So if you, like as a stock investor, this is kind of the easiest place to start. The hardest place to start is picking one company that you think is going to do well. And I just think that like for a beginner, that's a terrible place to start. There's lots of people who start there, but I just think it's not a good idea. Just don't try to pick one company. It's so difficult to do it. That's kind of a different issue. But here with just investing in stocks, and I'm using air quotes for those of you who aren't watching me, you know, investing in stocks, you can invest in this basket of 500 companies through an S&P 500 index fund or index ETF, where you're not making a call as to what the best companies are in the S&P 500. You're just putting them all together so that if one fails, it doesn't blow up your whole financial plan. But also, like if one does really super well, you don't get the whole benefit of, you know, investing in Tesla 5 years ago. But it takes the downside, much of the downside risk out. One company can go to zero. One company can go bankrupt and go to zero. Think, I mean, Hertz this year. Hertz versus Tesla, right? Hertz is bankrupt. Like no one is going to make any money from that company. It's gone, right? Well, it's not actually gone yet, but it's on its way out. So we kind of have to be thinking about going forward. Okay, like Hertz is gone, but something is replacing it. And that's by owning the S&P 500, you mitigate some of the risk that you owned Hertz before COVID hit. But always and forever, there are going to be winners and losers. That's the way that the system works. Like, we incentivize the companies that create the goods and services that we want to buy. We incent their company does awesome. And we punish the companies that can't deliver the goods and services that we want. They go into bankruptcy, or they get acquired by someone, or they just like fade away. That's what the system is.
It also seems like another area where like the disconnect between the economy, what we see in our daily lives downtown versus the stock market. So if you're looking at how it feels in your town, you could feel like this is a depression.
Right.
And really be much more conservative. And
right.
having this as a reminder that what we see with our friends, with whatever, is not the way the stock market is reacting.
It's interesting. I know this isn't the stock market, but Americans paid down more credit card debt than they ever have.
Yeah.
This year.
Oh.
I mean, Kate, that's an awesome point. I mean, I think, again, that is something that is supportive of the markets, because somehow out of this, not everyone, but a lot of people are coming out of 2020 in a better financial position, where they took all this time to not travel and spend all their money on traveling and paid down their credit cards and their student loans. That is a really like weird outcome that people didn't anticipate, but there are a lot of people who are in a stronger financial position going into 2021 than they were at the beginning of 2020. So there are kind of these, again, there's these underlying themes that aren't necessarily intuitive, but everything is is battling with the other themes in the economy and in the stock market. And that's what makes it so hard to predict, that you don't know how all of the interactions of these themes are going to actually end up.
I have a question.
Yeah.
Hey, this is Peggy. I'll turn my video on. Hi. I was thinking when Caitlin was talking about the downtowns and the businesses being boarded up, if that kind of goes back to one of your the other graph that you showed that shows like small businesses versus big businesses, like the large stocks versus the small stocks, that one, just because in our towns, we might see a lot of the smaller businesses like the mom and pop restaurants or things like that, but the bigger companies that are more infrastructure or just kind of these bigger corporations, that they don't seem to be hit as hard by these changes as the smaller businesses.
Yeah, I mean, you hit the nail on the head. I mean, there's these small US stocks, these are still very large companies, right? They're publicly traded companies. They're still very large. And so if you take this to the next step of like a mom and pop store or like a hardware store with 10 stores, something like that, right? Something that is small in the grand scheme of things. It is riskier to be smaller, right? Because you don't have the resources to get through disasters like this, or you don't have, you don't necessarily have access, or you don't have access to the best resources. Apple can borrow money at basically 0%. They could borrow as much money as they wanted to. Whereas right now, if you own a restaurant with 5 different locations, like, try to get a loan, right? Where are you going to get a loan? It's going to have to be something government backstopped, right? Because every investor would be like, that seems really risky to give you a loan right now. So that's like part of the risk return profile. But going back to secular trends, like one I didn't mention that you're hitting on here, Peggy, is it kind of used to be the case in the old-timey economy, right? That smaller companies could compete better with larger companies. But I think like in the era of big data and technology and scalability, the way our economy is going, it's moving towards like a winner take most type of dynamic, You know, like if you think about like the Walmart killing the mom and pop stores, right? But that's happening in all sorts of different industries now. Again, that's something that could be potentially changed with legislation, right? You don't allow those things to happen. But it makes larger companies, I think going forward, larger companies are less risky. And here, like here with the large US stocks, you can see that the large stocks are less risky with a higher rate of return. And that is fairly recent. Like over longer periods of time, there's all of this data that shows that smaller companies outperform larger companies, but that relationship has really broken down, I don't know, over the last 10 years, certainly, 10 to 15 to 20 years. And I think it's because of technology, like where can you afford to invest your money? So it's like still, you know, it's still in play. But Caitlin, like if you're walking around downtown and you're looking at a storefront of like a small shop, like, I mean, you probably pull out your iPhone to like call your friend to tell you where to meet you, right? So it's like the iPhone is still the thing, even though that store is closed.
Yeah.
Really good questions.
Hey, Sarah, we have another question in the chat box. So Jill is asking if we can write off stock losses on our taxes.
Yeah, so definitely talk to your CPA. The general idea is you can use losses. First, your losses offset gains. And then if you have any losses left over, you can use $3,000 a year to offset your income. So if you had, let's say you had a $5,000 loss this year and no gains, or you didn't realize any gains, which means you didn't sell anything to realize a gain. You could take your $5,000 loss. And by the way, you have to realize these gains and losses. That means selling the thing, selling the stock. It doesn't count if it's unrealized, if you didn't sell it. It only counts if it's realized. So if you have $5,000 in realized losses, you could use $3,000 of that to offset your income in 2020 and then carry forward the remaining $2,000 loss and use it next year. Or you could use it, or you could use it to offset any gains that you had this year on a different investment. So I know that was fast, but you can kind of, if you're looking, like I would look at something, I would look at tax loss harvesting, and tax loss carry forward would probably get you more detail on that concept.
I have a question, Sarah. Just as a more broad stroke and trends going forward, are there any sectors that you would advise people to stay away from? Like, for instance, I'm particularly concerned about like REITs in the real estate sector. Like you were talking about hospitality, but I think that hospitality, when we open back up, is going to boom.
Yeah.
But you know, like is it, you know, just as a general broad stroke.
I mean, I feel a similar way about commercial real estate, like you mentioned, because I think that things are changing there in a way that I don't understand, right? Like, or like if I think about companies decreasing their footprint while more people work at home, that seems like something that could logically come to pass. And as these leases expire, who are you going to get to fill these, you know, the square footage of all of these buildings everywhere? That is something that I think is still playing out, and there could be areas of that are much higher risk. Certainly, like if you're thinking of a high rise versus I don't know, maybe a REIT that specializes in multifamily housing, like the high-rise REIT, I think I wouldn't be super excited about going there, right? I think that there's a lot of disruption. Again, this was even happening before, but disruption in the energy, like oil and gas sector, I think is still happening, right? There's just all of these secular trends that I think are all coming together to make it really, really difficult to make money in oil and gas. And that's something that a lot of investors have had a really hard time letting go of, right? Because we all, well, not all of us, right? Some of us came up with this idea of the oil is going to run out. The price of each barrel of oil is going to go up and up and up. and, you know, it's going to be a disaster. There's going to be some sort of catastrophe. Where it's actually happened, like the opposite has happened. Like technology has come into play and made it cheaper for people to take oil out of the ground. Not as many people are using it as inefficiently as we did in the past, and the price of oil has plummeted. So now you have companies like Exxon who are like, oh, we over-invested in all of this stuff that we own. Like, this is going to be really tough to get out of going forward. So I think, you know, kind of the rise of Tesla and the electric vehicles, the rise of green energy, population changes, like population isn't increasing as fast as people thought it would. And some places it's not increasing at all. In some places it's decreasing. I think all of those things make it really tough to make money in the oil and gas space. So that's another one that I'm just like avoiding. And which is kind of a hard sell in Texas sometimes, right? So those are kind of the two main ones. But I think you're right about hospitality. Like, whoever survives, I mean, what are people going to do in 2021? Like, as soon as people are vaccinated, like my sisters and I are already planning a trip to Disney. Us and like every other family in the world, probably at this point, right? So I'm imagining it's going to be super expensive, right? But that they would be a beneficiary of that, like, okay, make up for lost time sort of dynamic. And certainly like restaurants, so like whoever is able to have the resources to make it to March or April or summer or whatever, I think that they'll do well after that. But that's kind of that's what a recession does even in normal times, right? Like a recession wipes out your competition. So if you can survive, there's fewer people to compete with. So that is like a normal aspect of capitalism. It's all just happening in a weird and dramatic way this time. Those are awesome questions. I might make it through my slides. Gwen, what time is it? I'm sorry, I don't know why I don't have a clock in here.
We're at 4:21.
Okay. I'm just gonna try to jam through the rest of my slides and leave some time at the end for anyone who wants to stick around. I showed this one, for those of you who've seen me speak before, you've probably seen the slide. You know, can you predict where the stock market is heading? It's really, really easy because of the way human brains are wired, really easy to fall into the trap of predicting the next catastrophe and why you want to avoid it. That's something I run into all the time with classes with this group. Is like, well, if this happens, then won't the stock market do poorly? Well, what about this terrible thing that's happening? What about that terrible thing that's happening? Terrible things are always happening, and there's never going to be a point in time where it feels safe to get into the water. Like, it just isn't going to happen. Like these things, they just keep coming, right? The catastrophes keep coming and coming and coming because of, I don't know, human nature, whatever it is. And you don't really know what impact is going to be the outcome of whatever the catastrophe is. Sometimes there's a catastrophe that spurs a market decline. Sometimes there's a catastrophe that doesn't have any impact at all. So I just like to show this because it really becomes easy to fall into the trap of trying to predict and avoid the next downturn that is event driven. And it's really, really difficult, right? Like, we can go back here and see kind of all of these bad things that have happened over the course of time, and things are going to continue to happen. But if you give the stock market enough time, the companies at least in the US, companies in the US have enough flexibility to change in order to adapt to whatever environment they're in. Some companies will die and some will grow, but the system is very flexible. It's just really flexible, really adaptable. And so, like, give our economy and give the companies in our economy, give them some credit, right? Give them the benefit of the doubt that a lot of those companies are going to figure out how to make money in whatever environment we're in. Here's just like the role of a diversified portfolio, right? I just spent a whole bunch of time talking about the stock market. So here, the green line this year is the Vanguard Total Stock Market Index Fund, VTI. So the green line is basically the broad stock market. The orange line is commercial real estate. Going back, Ruth, kind of to your question, commercial real estate, like, I think people feel the same way that you do about it. And then that little blue line cutting through the middle is just a bond fund, the total US bond fund. bonds are in your portfolio for stability. Look how stable that blue line is. Kind of had a little, little rough patch there back in March, right, when the world was ending. But most of the time, those bonds are stable. So if you need stability, your portfolio is probably going to have more bonds, less stocks. If you need more growth, then you're probably going to have to be closer to that green line than the red line. That means you're going to have more volatility, but over time, more growth. That's like the basics of investing. You have to figure out like which line you want to be closer to. Do you want it to be stable, but sideways, not growing very much? Or do you want to be up here in the green line, but you have to gut through all those ups and downs that you see? And that's just it's never going to change. That's just the way the stock market is. So that's how you choose investments. When do you need the money? Can you tolerate big swings in price? I have a little bit about inflation here. People worry a lot about inflation. I think because of this time horizon back here, like in the 50s, 60s, 70s, and 80s, early 80s, inflation is actually very tame these days, right? So I spend some time worrying about it. I wouldn't spend all of my time worrying about it though. It's just inflation is really low. Here's one inflation chart. This is the consumer price index. Here's another measure of inflation, the PCE. This gray line that it's trending around is a 1.5% annualized rate of inflation. So that 1.5% is lower than the Federal Reserve's target, what they're trying to get it to, 2%. And it just really hasn't budged. A lot of people, like most economists, or maybe no economists, actually know what causes inflation or disinflation or deflation. But that's something that often comes up as a concern for people is inflation. Certainly you have to worry about while you're investing. You want your investments to keep pace with inflation. Like right now, if you're in cash at 0% and inflation is running at 1.5%, you are losing 1.5% per year, right? Again, that comes back to Tina, there is no alternative. People aren't gonna tolerate that for very long before they start putting their money in something riskier. But that 1.5% rate of inflation, most people would guess that it was higher than that, or that it would be expected to be higher than that in the future. And I just don't know if it will be. I think it'll be, 1.5% inflation rate is benign, right? You do have to invest in something other than cash if cash is at 0. But inflation just hasn't turned out to be a big deal for a long time. Some stuff on taxes, we'll know more after Georgia as to who has power to raise what taxes. And then we talked about this last week, or last month, the Secure Act. So kind of run through this especially if you're inheriting an IRA in 2020 or after, kind of come back and run through these slides. The CARES Act, you don't have to take a required minimum distribution from any IRAs in 2020. If you have some COVID-related reason, you can take you can take a distribution from a retirement account and not pay the penalty. You'll probably still have to pay taxes, but you might be able to avoid that 10% penalty. So you might want to look into that if you're in dire straits going into the end of the year. And your deadline is the 30th of December, not the 31st, the 30th. So I just wanted to bring that up. So now I think maybe I have like a minute for some questions. I know we had some good ones as I was running through the slides, but I'm happy to stick around and answer any questions that pop up. But before I do that, before I answer more questions, I do want to say thank you to everybody for being here today and for being a member of this awesome group that is truly, like, I feel like it's the best. It's like the best part of my year when I get to do these meetings. And I feel like you all put such good into the world and such good vibes come back to me. And so I just wanted to really say thank you for being here and happy holidays. But if you want to get back to the work stuff, I'm happy to stick around and answer any questions on anything I can possibly answer. So I'm happy to stick around. I'm going to go back to Brady Bunch style. Here we go. Anyone? Was it just like overload for the holidays? You're like, this is a celebration meeting. Sarah, take it down a notch.
I have a completely selfish question, and I will just, I already asked it to you, but I was curious if you wanted to, speaking of hospitality in the industries that might survive and do well. As you know, Airbnb is now going public. And I was just curious what your thoughts were about Airbnb and I guess VRBO, like how that part of the hospitality industry.
Yeah, I mean, I think those companies are, I mean, like so many companies that end up making a gajillion dollars, they're platforms, right? They don't own any of the buildings. They just facilitate renters renting it and take a cut of it. It's a really, really efficient business model, and it's really easy to scale it, right? To grow it. So, I mean, that's that's how the companies that are the largest companies in the world got there, by being platforms, right? It's like Facebook doesn't create any content. They just give you a platform to put your content out into the world, right? So I think that I would guess that Airbnb would be similar, right? It's already a very large company and very successful. Who's going to compete with them, right? Maybe VRBO. I mean, but it seems like a very efficient, very lucrative business model. It's funny though that they were one of the companies like in March, like I was reading some article where their CEO was talking about they were really, really close to failing, right? They like did not have enough cash on hand to keep things going. They ended up getting whatever it was, like a loan or whatever it was to get through that cash crunch. But I think that now that they've come out the other side, kind of going back to what Ruth said and thinking through like, okay, how are we going to take vacations in 2022? Right? Like some people will go to hotels, right? But a bunch of people are going to book on Airbnb. And I think a bunch of people are going to look for real estate or build real estate or invest in real estate that you know, where you have that rental unit that you can turn into cash when you need it, right? I know you have one, Caitlin, I have one, right? Like, okay, if I needed to generate income, I would rent out my ADU, right? Or rent out a room or something like that. So I think that as like a platform company, I think it's going to, again, it's a secular trend, right? It's not the next big thing. It's like already a big thing. And I think it's always going to be a big thing and maybe get even bigger. So that's just my hunch. Good question.
Has anyone ever bought stock for kids, like for a Christmas present?
That's a good question.
I was just thinking I could give like my nephew like, you know, $20 in stock and $20 in cash. Like he just saved up $300 for an iPhone. He's 10. So I was like, I don't know. Has anyone ever done it? Do they understand? Or maybe I can wait till he's in 5th grade or something.
I'm kind of interested in like, if you would lay the groundwork and later, like when he'd be into it.
Yeah.
So it's a really cool idea. Like, but would you give him like a stock certificate or would you like show him like the share?
Like in my mind, this is a very like the very beginnings idea. Just like create a little booklet of like the top 10 stocks and be like, hey, you own a little piece of all these companies, you know, and then if you want to know how much this is worth, check the Google the number and you can see how much it's worth today. Something very simple, like just one share of an index fund.
Yeah.
I saw a price for $13. I don't know if that was wrong because I know that some of them were really expensive.
Yeah.
But I don't know. I was just curious.
When I was growing up, I did we had some sort of like stock market extra group or something. I don't even know how this came about, but I was in 7th grade where we did a stock market project. And it was, you know, like you picked the companies and then you would look up the ticker symbol in the paper and track them. And even then, I don't remember like having any real affinity towards this project, right? But I'm curious like what he would know now about it. Like what does he know about money now or stocks now?
Well, he knows that he can save up everything to buy something really big.
Yeah.
So I was thinking if he has like $20 in the hand and then $20 in this like somewhere land and he can check the price on it. I mean, it's not a very big, you know, I wouldn't spend a whole lot of money on it, you know. But
I think it's a cool idea. let me know how you figure it out, like, and what you do.
Yeah, I was just thinking of creating kind of like a portfolio. Just a very like ABC 1, 2, 3 like portfolio. Here you own a little bit of
I
this.
think he would be amazed by age 18, right? Like 8 years into it. If you gratification at age 10, if he at 10 is like my daughter at 8, like it's all about instant gratification, right? So it's like very bad for investing to be about instant gratification. But if at age 18 you've done this, like every year, like you buy a stock and put together a portfolio and then give him the portfolio when he's a grown-up, I think that would be super cool to be able to show him, right? That over 8 years, look what your Kate did. Like, you made all this money, you didn't even do anything. You should keep doing this as a grown-up.
Yeah.
Super cool lesson.
That could be interesting to keep doing it every year. And then how do you transfer over a stock? Like if I buy it, maybe I just keep it in my name for a while until someday I transfer it over to him or his parents.
Yeah, you could open a UTMA, which is a Uniform Transfer to Minors Act, where you're actually giving the kid the money, and then they get control over it. In Texas, it's age of 21. That's when they reach the age of majority. In other states, it's 18. So you could do it that way if you actually want it to be in his name. But if this is just like trying to figure out what the system is, I would probably keep it in your name just to. You can always gift it to him later, right? He would inherit your cost basis. So if you bought it at $20 today and then you give it to him and it was worth $50, if he sold it, he would then pay taxes on that $20 purchase price. So he would inherit the cost basis either way.
Okay. That could be fun.
That could be fun.
Yeah. I don't have to get the fancy gift. I can just, grandparents take care of that.
Yeah, yeah.
This is Lindsay. I was going to say, since he has an iPhone, maybe do some research to see what kind of finance for kids apps there are.
Yeah.
And see if there's like something he might be interested in or that's easy for him to, I don't know, create a budget or something that can just be an intro for investing or an intro to financing for kids.
Yeah.
See if there's anything out there. I don't know if there is, but.
Yeah, he bought my sister's old iPhone from her.
Oh, okay.
You can pay off her bill.
Yeah.
Or I was going to say, you could even buy, I know like Schwab has slices now where you can buy percentages of the Apple if he's interested in Apple. So, or, you can buy just certain amounts of Apple stock. That might be something he's interested in. So
that's a great idea, Ruth.
That's even simpler. It's very simple. Apple's probably going to do good for a while.
I would think like with kids, it would be Apple, Disney, like the names that they come across all the time, like maybe Nike if they're into sports or something like that, right? Where there kind of are those names that like are brand name enough and are good companies, right?
Mm-hmm.
Where you put together a pretty cool portfolio. That's a good question.
Yeah.
Sandy said she has a UTMA for her 14-year-old and he doesn't care today. But he will one day. Oh.
Yeah, he may not care. Only not 10.
Well, this has been great, everybody. Certainly, like now or in the new year, whenever questions pop up, let me know. Otherwise, I don't know. I'll see you in 2021. Fingers crossed that it's better than 2020, right? I'll even take a sideways market for a better year, right? Versus like a pretty good stock market in a crappy year. But that's just me. I'm willing to make that trade. But we'll see. Hopefully we can get both, a good year and some good markets. Oh my gosh, is Sam behind you, Lori? Well, this has been great. Gwen and Lori, thank you so much. Thank you. And we'll see you guys later.
See y'all later. Happy holidays.
Happy holidays.
Thanks for doing the presentation. Thanks for the presentations.